Picture two investors watching the same market storm. One owns a portfolio and hopes the weather improves. The other begins by asking a colder question. Which exact loss would break the plan? And what position would move the other way if that loss arrived? That second question is the beginning of hedging. A hedge does not make uncertainty disappear. It reduces, transfers, diversifies, or reshapes a named risk, usually in exchange for money, complexity, or surrendered upside. This film is education, not personal investment, tax, or legal advice. The simplest analogy is insurance. A homeowner pays a premium not because a fire is expected, but because one fire would be financially intolerable. In markets, the premium may be literal, as with an option. It may also be an opportunity cost, holding cash that earns less than stocks, fixing a currency rate and missing a favorable move, or selling future upside to fund downside protection. A good hedge is judged against the damage it was designed to limit, not by whether it makes money every month. That distinction separates hedging from speculation. Suppose a company will receive euros in 90 days, but pays its bills in dollars. Selling euros forward offsets a real exposure. A trader with no euro revenue who sells the same contract is making a directional bet. The instrument is identical. The purpose and sizing are different. Every genuine hedge therefore starts with an exposure, an offset, a ratio between them, a time horizon, and an exit condition. Without that map, the word hedge can become a comforting label for a second risk. The modern hedge fund story is often traced to Alfred Winslow Jones. In 1949, his partnership combined stocks it expected to rise with short positions in stocks it expected to fall. The long book sought company-specific winners. The short book reduced part of the broad market exposure. Jones also used leverage, which could amplify stock selection skill, but could also magnify mistakes. The structure was innovative because it separated the question, which companies are better, from the question, will the entire market rise or fall? But the name hedge fund never guaranteed safety. A long-short portfolio can still carry sector concentration, hidden leverage, crowded trades, expensive borrowing, liquidity risk, and correlations that change during panic. Protection can be too small, too large, too early, or attached to the wrong asset. The useful promise is narrower. Define the risk before the trade, pay knowingly for protection, and measure success by survival rather than by a perfect forecast. Next, we will open the ledger and see exactly how long and short positions create that offset. A long position is the familiar side of the ledger. You buy an asset, become exposed to its price, and hope it appreciates or produces income. If a share rises from $100 to $120, the long position gains $20 before costs. If it falls to $70, the position loses $30. The most that an unleveraged buyer can lose is the amount invested, while the upside is theoretically open-ended. The position has positive market exposure. Rising prices generally help, and falling prices generally hurt. A short position reverses the sequence. The trader borrows shares, sells them today, and later buys shares back to return to the lender. Sell at 100 and repurchase at 70, and the gross gain is 30. But the short seller must post margin, may pay a borrow fee, owes substitute dividends to the lender, and can be forced to add collateral as the price rises. Shares can also be recalled. Shorting is not simply pressing a minus button. It is a financed position with operational constraints. The payoff is asymmetric. If the stock rises from 100 to 160, the short loses 60. If it doubles again, the loss grows again. A long position cannot fall below zero, but a short position has no fixed maximum loss because a price has no fixed ceiling. That asymmetry is why squeezes can accelerate. Rising prices create losses, losses trigger margin calls or risk limits, and forced repurchases create still more buying. A position intended as protection can become the portfolio's largest source of danger. Now combine both sides. Imagine $100,000 long, a strong bank, and $100,000 short, a weaker bank. The book is dollar neutral, but not necessarily risk neutral. The two banks may have different volatility, sensitivity to interest rates, or exposure to credit losses. Beta neutral sizing adjusts the legs so their estimated response to the market is closer. A paired trade tries to isolate the relative difference between two related assets, yet its success still depends on the relationship remaining stable. The animation on our ledger will keep changing because real hedges keep changing. A rising long leg increases the exposure that may need protection. A falling short can shrink its offset. Borrow fees can jump, volatility can change, and a corporate event can break the pair. The practical rule is simple. Know what the short is offsetting, stress a violent move in both directions, and size for the loss you can actually finance. Long and short are building blocks. The next question is, which tools combine them efficiently? The cheapest hedge is often not a derivative. It is avoiding a concentration that never needed to exist. Position limits reduce the damage one idea can cause. Diversification spreads dependence across companies, sectors, countries, currencies, and economic drivers. A liquidity reserve prevents a near-term bill from forcing the sale of a long-term asset during a decline. These layers will not protect against every shock, and assets that looked different in calm markets can move together in a crisis, but resilience should come before engineering. Futures and forwards lock or offset a future price. A farmer can sell crop futures before harvest. An airline can hedge part of expected fuel exposure. An exporter can sell foreign currency forward against a contracted payment. These tools are efficient because little cash may control a large notional amount, which is also the danger. The hedge can require margin, create roll costs, and differ from the exact asset being protected. That difference is basis risk. The proxy moves, but not enough, or not at the right time. Options make the insurance idea visible. A protective put gives its buyer the right to sell near a chosen strike, creating a floor before the premium and other costs. A caller can reduce that premium by selling a call, but the sold call caps some upside. Investor, if puts reduce losses, why not hedge everything forever? Host, because protection expires, repeated premiums reduce compounding, and the option may not match every holding. The first decision is not which option to buy. It is which loss the plan cannot tolerate. Swaps exchange one stream of payments for another. A company with floating rate debt might pay fixed and receive floating through an interest rate swap. A commodity producer may exchange a market-linked price for a more stable one. Pair trades and market-neutral portfolios use long and short positions instead of contractual insurance. Each method introduces its own failure modes: counterparty exposure, collateral calls, liquidity, model error, tax treatment, early termination costs, or a relationship that stops behaving as history suggested. Sizing connects the tool to the problem. A hedge ratio of 50% means only half the measured exposure is offset. Not that the portfolio is 50% safe. A perfect one-to-one hedge is rare because exposure, beta, duration, and volatility change. Build a method selector. Name the risk, choose the closest instrument, estimate behavior in normal and stressed markets, calculate all carrying costs, and define when protection ends. There is no universal safe asset. There are only specific offsets for specific risks under specific conditions. Companies hedge for a practical reason. Stable cash flow helps them price products, plan investment, protect payroll, and avoid raising money during a crisis. The objective is rarely to beat a trading desk. It is to narrow the range of outcomes around an operating plan. A bakery worries about wheat, an airline about fuel, an exporter about exchange rates, and a borrower about interest payments. The most useful hedge follows the physical business exposure in amount and time. A contract that extends beyond the business need can become a new bet. Southwest Airlines offers a vivid fuel example. In its annual report for 2008, the company described hundreds of derivative instruments connected to future fuel costs and reported about $1.3 billion in cash proceeds from fuel derivatives related to that year. Those positions helped when energy prices were high. But oil then fell sharply, reducing the value of future hedges and forcing the company to modify its portfolio. The same contract that stabilizes costs against a price rise can look painful when the unhedged market price collapses. Consider a manufacturer that will receive 10 million euros in 3 months, while its wages and debt are in dollars. The sales contract creates euro exposure today, even though cash arrives later. A forward sale can lock the dollar value of that receivable. If the euro falls, the forward offsets part of the revenue loss. If the euro rises, the company gives up part of the benefit. The hedge has not failed. It exchanged an uncertain conversion rate for a more predictable budget. Accuracy depends on the payment amount and date actually arriving. Interest rate risk follows the same logic. A business with floating rate debt benefits when rates fall, but pays more when rates rise. Through a swap, it may pay a fixed rate and receive a floating rate, turning part of the obligation into a more stable cost. Commodity buyers can use futures, options, or supplier contracts. Producers can lock selling prices. Yet, over-hedging forecast demand is dangerous. If production is canceled or sales disappear, the derivative remains while the operating exposure has vanished. Accounting labels do not create economic protection. A hedge can reduce cash flow volatility while showing temporary mark-to-market losses, or qualify poorly for hedge accounting while still offsetting the business risk. Boards therefore need a policy, approved instruments, counterparties, maturity limits, collateral rules, hedge ratios, and independent reporting. The lesson from corporate practice is disciplined humility. Hedge the exposure the company truly has, not the commodity or currency view management wishes it had, and prepare for the world in which the forecast itself is wrong. Financial history becomes memorable when a position meets a regime change. The popular version celebrates a brilliant trade or mocks a failed model. The useful version asks 4 questions. What was the underlying exposure? How was the position financed? What assumption connected the hedge to the risk? And what happened when liquidity disappeared? 2 famous episodes, the pressure on sterling in 1992 and the near collapse of long-term capital management in 1998, show why the words short, hedge, and safe should never be treated as synonyms. In September 1992, the United Kingdom was trying to keep sterling inside the European exchange rate mechanism. The Bank of England recorded exceptionally turbulent markets, heavy official purchases of sterling, and the suspension of sterling's ERM membership on September 16th. Macro funds and other traders had sold the pound, expecting the defense to fail. The trade became legendary, but it was directional speculation unless it offset an existing sterling liability. A short can be profitable and historically important without being a hedge for the trader who placed it. Long-term capital management looked closer to the textbook image of sophisticated hedging. Its portfolios compared related securities, betting that price spreads and volatility relationships would move toward historical norms. The fund used repurchase agreements and derivatives to lever those relatively small differences into meaningful returns. For several years, the approach produced an enviable record, but leverage made a quiet assumption enormous. Positions had to remain liquid, counterparties had to keep financing them, and relationships that looked stable in the data had to survive a global rush for safety. In 1998, risk aversion rose and spreads moved sharply instead of converging. Federal Reserve testimony later said LTCM had lost about half its capital by the end of August, while its complex positions stretched across markets, maturities, and currencies. Closing everything quickly threatened a fire sale in already fragile markets. On September 23rd, private institutions agreed to inject roughly $3.5 billion and take control while the portfolio was reduced. Federal Reserve funds were not placed at risk, but officials facilitated the discussion to support an orderly resolution. The lesson is not that models, short positions, or relative value trades are useless. It is that a hedge measured in normal conditions can become a leveraged liquidity bet under stress. Correlations move toward 1, bid-ask spreads widen, margin demands arrive before positions recover, and several funds may try to exit the same door. Good risk management therefore tests financing, crowding, and liquidation, not just final payoff. Ask what happens on the path, who can demand cash tomorrow morning, and whether the supposed protection survives before the forecast is eventually proven right. A practical hedge plan can fit on one page. First, name the risk in a complete sentence. A 20% equity decline would delay a required payment. A weaker euro would reduce contracted dollar revenue, or higher rates would breach an interest coverage target. Second, measure the exposure in money and time. Third, choose the closest offset. Fourth, budget premium, carry, margin, and opportunity cost. Fifth, write the failure modes. Sixth, define the event or date that closes the hedge. If any line is blank, the trade is not ready. Sizing should begin with the damage, not with a dramatic market prediction. Imagine a $500,000 equity portfolio with an estimated beta of 1.2. Its broad market exposure is closer to $600,000 than $500,000. A $300,000 index offset would target roughly half that estimated beta exposure. The numbers are illustrative, and beta can change exactly when it matters. The calculation is a starting hypothesis to stress, not a promise that losses will be cut precisely in half. Now, test the ways the hedge can disappoint. Basis risk means the instrument and exposure diverge. Timing risk means protection expires before the shock. Liquidity risk means the quoted price is unavailable at the required size. Counterparty risk means the other side cannot perform. Funding risk means margin arrives before the hedge pays. Behavioral risk means the owner removes protection after paying for months, then restores it only after fear makes it expensive. A robust plan shows these failures beside the expected payoff, not in fine print after the trade. Monitoring should be boring. Track the exposure amount, hedge ratio, premium or carry spent, collateral available, counterparty concentration, maturity dates, and the reason the trade exists. Rebalance only when a written threshold is crossed or the underlying exposure changes. If a company receives less foreign currency than forecast, reduce the forward. If shares are sold, reduce the index hedge. If the unacceptable loss is no longer possible, close the protection. A hedge without an exit rule can outlive its purpose and quietly become speculation. The final principle is restraint. Diversification, liquidity, position limits, and a survivable time horizon solve many risks more cheaply than derivatives. Use options, futures, forwards, swaps, or short positions only when they address a remaining loss that truly matters and when their mechanics can be explained on one page. The goal is not maximum profit with minimum risk. Markets offer no such contract. The goal is to keep one shock, one forecast, or one forced sale from ending the plan. Hedge the risk you have, pay the cost knowingly, and keep compounding.